What's depreciation expense? You see, depreciation is a very complicated accounting topic, and there's a lot of different leeway that go into it. And as we've already learned looking at the balance sheet, it shows up there and it shows up here on the income statement. And eventually you're going to find out that it kind of affects the cash flow statement too, but in even a weirder way. So depreciation is a very weird accounting idea. In accounting, depreciation really refers to two different ideas. The first one is what we saw on the balance sheet. The idea that an asset decreases in value over time. That's like, remember, buying a car, driving out of the lot, and it goes down in value. It's the opposite of appreciation, which is going up in value. Now, the second concept kind of touches on the matching principle. You see, when you do buy a car, you need to be able to allocate that cost of a car to your income statement in costs some way, somehow. And you can do that by looking at the useful life of that car. To create depreciation expense, accountants have to calculate how long an asset will stay useful. For example, a laptop might be 3 years, a camera might be 5 years, a car might be 20 years. It really matters on what exactly the asset is. However, the cost of that asset is then divided by how long that useful life is. So for example, let's say the laptop is good for 3 years, the camera is good for 5 years. So let's say that we paid $600 for a laptop and $1,000 for a camera. They're gonna both cost us $200 each year. 600 divided by 3, $200. 1,000 divided by 5, $200. So for both those assets, we're actually going to put $200 each into the depreciation expense on our income statement for that year. This does not mean the company actually paid $200 each year for those assets. They already bought them. They already paid $600 for the laptop back in the day. They already paid $1,000 for the camera a few years ago. But because that, they're actually allocating exactly their core amount for their useful lives on the expenses as they use them. A little bit like the matching principle and cost of goods sold. Remember, if you bulk order all the bread and meat that it takes to make the sandwiches, but you only make 10 sandwiches, you don't have to register all those costs immediately, just as you use them. The same thing kind of here with the assets and depreciation expense. As you use the camera for the next 5 years, you allocate a little bit of that cost throughout those years. No cash actually changes hands except for that very first year, when you first bought the camera or laptop. Everything else is just accounting and the ability to be able to record when this asset was used over what time period. That's what makes depreciation a little bit weird. Since there's no cash kind of changing hands for most of the time, but you spent a whole bunch of money when you first bought it, it gets a little tricky. That's why depreciation expense is very important to look at from an analyst perspective. And now you'll know a little bit more about why it's always considered an operating expense. So let's recap real fast. Depreciation shows up on both the balance sheet and the income statement. While the balance sheet showed a little bit about how something falls in value over time, the income statement shows how much it fell every year that it's used. And those two ideas go together to make depreciation as a whole very important to the operations of a business. All you have to remember is that depreciation is how accounting deals with buying something in the past that you still use today.